Leverage is most certainly one of the most polarizing subjects in trading. Because it is largely misunderstood at the technical level, it tends to be treated emotionally in an extremely binary fashion that is both reductive and counterproductive. This bipolar approach will often result in either abusing it recklessly because of greed or irrationally rejecting it wholesale because of fear. Both reactions are wrong, obviously, and the least that can be said is that the trading community, mainstream media, and regulators are doing a pretty damn good job of confusing you about how you should approach leverage in a healthy, objective, and level-headed manner. So in this course, we are going to deconstruct the concept, understand why leverage is essential to your trading success, and especially how to use it to your advantage without jeopardizing the long-term survival of your trading account. So strap in and let's go for it. The headlines about mass liquidation events and retail traders getting wrecked is the fear-based smokescreen at the root of most confusion about leverage. Building up an emotional public response to financial distress and personal drama has been the vector consistently used to demonize leverage and justify choking individual investing with more blanket regulatory limits and arbitrary constraints, stifling your financial options no matter your level of competency. As always, everybody loses. The government power grab does not come with any financial education empowering you back with a sound comprehension of the issue at stake, because the power grab itself was the goal, not your education, let alone your safety. The truth is that leverage is nothing but a neutral tool. In fact, it is a dial, one that is not only useful, but will become straight up essential in your toolkit as you progress in your understanding of what trading really is, which is nothing but risk management, as opposed to obsessing over becoming a millionaire in 3 weeks with a $500 investment as you are consistently being bombarded by social media clowns. This video is not meant to go over what leverage technically consists in. It is pretty basic really, and there are many videos about it online that did just as good a job of explaining it as I would. So very quickly, leverage is a risk and return magnifying tool that is based on debt, which means that it lets you control more dollars than the dollars that you put down as collateral according to what is called an LTV or loan to value ratio that itself is set by your broker. Obviously, it cuts both ways. You can both make and lose money faster. And should your collateral become insufficient to cover your margin requirements and your debt exceeds your maximum allowed LTV, then you would receive what is called a margin call and your account would be liquidated. Fairly straightforward stuff. So much so, in fact, that it is not what matters most. The implications of leverage go well beyond the basic use that new traders make of it, which is very often for nothing more than the greed-induced emotional rush of seeing bigger numbers flip in front of their eyes. Past the irrational entertainment value, there is a quantitative rationale to follow in order to make sense of what leverage really is. And as always, before we understand what it is and how it should be used, we need to dispel some myths about it. Myths that are so ingrained in the mainstream trading culture that they block any constructive approach of the concept. So let's wipe the slate clean right now. First of all, despite all the hype about leverage caps and regulatory limits, lower leverage does not make you safer at all. In fact, as a retail trader, low leverage will likely make you worse off in most cases. So how does that even make sense? That is because low leverage promotes the status quo and is much likelier to stunt you in your progress as a trader. Low leverage not only does not change the long-term outcome of your trading strategy, but by slowing it down, it also falsely gives you a lingering and illusory sense of control that is less likely to let the market hit you hard when you fail, precisely when it should have been hard enough to make you completely question the way you go about trading had you been left to your own devices. You see, if high leverage can break a good strategy indeed, low leverage won't turn a strategy with negative expectancy into a winner. Low leverage only delays the inevitable outcome. It does not change it. That is why I'm saying that in most cases it is better to get your ass kicked quickly and question yourself enough to improve, rather than to watch your account turn into a train wreck in slow motion over weeks. And as we will repeatedly go back to during this course, expectancy is all that matters. Leverage is just a dial knob attached to it. The second myth is asserting that there is such a thing as a leverage threshold that is necessarily bad. This cookie-cutter blanket statement stems from the misunderstanding that leverage is actually a relative measure, not an absolute one. There cannot be such a thing as something like, oh, you should never go above 10-for-1 leverage, for example. That makes no sense mathematically. So now, why can leverage only be correctly understood from a relative standpoint? That is because what matters is your realized leverage, not your nominal one. Let me explain. Let's say that you intend to apply 100% of your account equity to either trade asset A or asset B. Your broker is allowing you to take up to 50-to-1 leverage. Asset A has an average volatility of 0.5% a day, asset B 12% a day. Now, everybody in your trading forum tells you that you should never use more than 10-to-1 leverage as a rule. No explanation provided, as usual. So without knowing any better, you go for it. At 10-to-1 leverage, your account will now move by an expected average of 5% a day if you trade asset A, or 120% a day if you trade asset B. As you can see, it's pretty obvious to see here that if the nominal leverage is the same, the outcome is widely different. Why? Because your trade's volatility does not depend on leverage alone, but rather on both your leverage and your underlying asset's intrinsic volatility, the combination of which yields your expected realized leverage, which is all that you should care about. Once you understand that, it's pretty easy to understand now that what may seem like an insane amount of leverage on, say, Forex may in fact not be that terrible once you adjust it for the intrinsic volatility of currencies, which is in general only a small fraction of other instruments such as, say, stocks or commodities. And finally, turning to our third myth, which is that leverage would somehow systematically create unlimited risk by design. That too is not true. Your maximum risk cap really depends on the type of instruments that you intend to realize your leverage with. For instance, if futures, CFDs, and short equity options do indeed bear the theoretical risk of unlimited losses, your risk on most long options, for example, is capped to the money spent on the premium. Yet, you get leverage with all of them. Likewise, even with those leveraged derivative instruments that do bear a potentially unlimited loss, you can still minimize the likelihood of a margin call to almost zero by dialing in said leverage intelligently according to a process that we'll review in a second, and that virtually caps your risk with an extremely high degree of confidence. And on top of that, in case your judgment wasn't enough, most brokers nowadays have introduced what is called a negative balance protection for retail investors in many jurisdictions, even if it obviously comes at a cost through higher fees. So now we've clarified the general perception of leverage, let's move on and focus on how to properly use it. As I said, leverage is nothing but a magnifying tool. It enhances the characteristics of your trading strategy, but it does not change them. Understanding leverage is essential because of its direct involvement on how to properly size your trading positions, a technical aspect that was covered in depth in this video, link in the top right. As you will see in that video, leverage can be all kinds of measure, including negative if need be. But what I want you to do today is take a step back from the technical intricacies and understand the ramifications of what you are actually doing when using leverage, and especially when to use it and why. There are three distinct aspects and use cases inherent to leverage, most of which with tight relationships with what was purposely explained in previous videos. So in case you get lost from here, don't fret. All you will have to do is downshift a few gears and watch these classes in order first. So the first use case of leverage is that of capital efficient risk mitigation. This is typically achieved via derivatives, which primary purpose, believe it or not, is to hedge risk, not to take outsized speculative bets. Thanks to its embedded leverage, a derivative instrument will allow you to lower your net portfolio risk while preserving capital efficiency, meaning that it will spare you having to rebalance and sell all or a portion of your portfolio and pay the associated commissions every time you need to hedge yourself wholly or partially. But there is a silver lining. You have to keep in mind that unlike selling your assets outright and going to cash, derivatives hedging is an imperfect solution, a work in approximation, either because of the very way most derivatives are constructed, how closely their performance is pegged to that of the asset or index that they are meant to track, or the hybrid and or evolving composition of your portfolio. The leverage embedded in options, for example, is not constant across the life cycle of the instrument, let alone the evolution of the market. Likewise, hedging with futures should factor in rollover costs and their term structure, etc. So you will find yourself having to either settle for an approximate hedging effect or having to regularly rebalance your hedge. If you want an overview of how this is achieved with cryptocurrencies, I already made a video for you where I presented a step-by-step practical example as well as the limitations of this exercise. By the time you're done watching it, you should have a fairly good hands-on understanding of how this is done and where to set your expectations. The second use case has to do with dialing systematic performance. As you should know by now, performance-wise, your strategy's expectancy dictates the static reward-to-risk ratio embedded in your system. This static feature cannot be modified, regardless of leverage, unless you alter the algorithmic logic of the strategy itself, of course. Your expected rate of return, however, is a choice, not a feature, and this is where your leverage comes into play, to dial the magnitude of that reward-to-risk ratio that, once again, you cannot know definitively until after your trading system has been crafted and quantified. Remove that preliminary quantitative engineering step from the equation, and you will be left totally blind as to what leverage to apply, simply because you will not be able to quantify it. You heard me right. Without quantitative trading, there is no way you can properly use leverage. Actually, let me state it differently in very clear terms once again, because this point is crucial for you to understand. Without knowing those objective quantitative features generated by your strategy, there is no way to apply leverage in a safe and appropriate manner. Only quantitative trading solves this issue, and this is why so many people get burnt by leverage, because they have no idea about the compounded annual growth rate to maximum drawdown ratio generated by their strategy in the first place. That's exactly what you get by relying on inconsistent and subjective chart reading and still call it a strategy when it is anything but one. Quantifying your strategy's key characteristics, however, will allow you to use leverage in a way that precisely dials your performance profile in or out, in such a way that both fits your yield target and your own risk aversion. Let me give you an example. Let's imagine a systematic strategy that generates an expected performance of 1.22, with 1.22 being the MAR ratio. Your unleveraged CAGR as designed is plus 18%, and your maximum drawdown is minus 14.75%. You know yourself, and the fact that you generally remain comfortable with losses as long as your equity retreats by 20% or less, then clearly you would dial your leverage in such a way that accommodates for this preference, and you would solve for the max drawdown, which in turn would imply an expected annual rate of return of plus 24.4%. Obviously, you could flip the logic and solve for the CAGR depending on your objective, but I think you get the point. Leverage is not only not dangerous intrinsically, it is a prevalent tool to mold a trading system's behavior around the only subjective parameter of trading, which is that of your own personal risk aversion. The third use case is a byproduct of the second one. It is associated with mandatory volatility enhancement that may be required by a certain market because of its own volatility or by the cost structure of your broker. Let me explain both aspects. Let's take the example of forex trading on the euro-dollar pair. This pair usually moves within an average range of 80 pips on a regular day. That's about 0.8% deviation, which is obviously not a lot to make it worthwhile in active trading. But because of the way they've been groomed by mainstream media, most people will run for the hills at the mere mention of a 50-to-1 leverage ratio. That is totally irrational, however. In my case, for example, my broad portfolio will usually allocate no more than 1.5% of my account to a standard single position. Scaling a 1.5% position with a 50-to-1 leverage on a market moving by an average of 0.8% will literally mean adding 0.6% of equity volatility to my portfolio. Does a 0.6% volatility contribution sound outrageous to you within a decorrelated portfolio? I can assure you that it's business as usual. Now here is where it all ties in with volatility. As you can see, because Forex is such an intrinsically low volatility market, high nominal leverage is absolutely required to make it worth trading at all and have this position stand a chance to impact your bottom line. As I mentioned it, your focus should not be on the headline nominal leverage amount, but on the realized leverage. But wait, there is another situation where high leverage might not only be acceptable, but mandatory in order to trade a market profitably. Put yourself in the shoes now of a brand new trader that wants to actively trade the European equity market. Because his starting equity of 3,000 euros is low and he cannot afford diversifying across 50 positions, he intends to trade his new strategy on an index ETF instead, namely the Eurostoxx 50. Also, his starting capital happens to be some mad money, so he is not too concerned about his drawdown. He merely wants to put this capital to work to get his feet wet by trading live for the first time. However, he knows that his strategy's expected net gain per trade is 0.4% over time. Yet with his broker charging 3 euros per trade, he's literally going to burn 6 euros or 0.2% round trip in commissions, leaving him to pocket only half of his expected net gain in the best case scenario. It's just not worth it. But his brokers offers an option though, to leverage his account up to a 10-to-1 ratio. Should he use all or some of it, his commissions will remain 3 euros per trade, or 6 euros round trip still. So since he's not worried about drawdown, he figures he's going to use the maximum leverage, making his position a 30,000 euro position to start with. All of a sudden, his expected net position gain goes from a mere 0.2% to 0.38% after fees. Now it makes economic sense to trade. Of course, it goes without saying that he would have to check whether his strategy's expected leverage max drawdown would not burn through his €3,000 equity, but you get the idea. Leverage can often be required to offset trading costs in a way that makes a strategy economically viable. I think it should be self-evident by now that leverage is not evil in itself, and there's no need to freak out about it. Just like any weapon, it is a neutral tool that can be used for good or bad. I cannot stress enough the fact that you should not use leverage under any circumstances unless you know the profile of your strategy inside and out, and I mean quantitatively so. Leverage only makes sense from a quantitative trading standpoint. There is no such thing as one-size-fits-all leverage amounts that, if it remains under such or such threshold, will keep you safe from going bust. There is no such thing either as setting an arbitrary stop loss on a position, having bet an arbitrary percentage of your account per trade, using arbitrary entry and exit rules in order to decide what amount of leverage to use. I hope you do realize by now the sheer nonsense that most social media trading channels push on you, literally making you believe that the tail wags the dog. They are misleadingly flipping the script on you. Leverage should not have that power on your trading decision making. If it does, then you're doing it wrong to start with. Leverage should be the last step in trading system design. Its implementation pertains to position sizing, which itself should come after everything else. Safety in trading can only be derived from a deep understanding of your strategy, which leverage has nothing to do with. It is the subjectiveness of your trading rules that will kill your account. Leverage alone can only make it faster. So work harder on your system design first and keep leverage as a mere add-on component to be quantified to complement your strategy for the sole purpose of your trading success. Make me proud, guys. I'll talk to you in the next class.